Good evening. So my name is Jackie Mallet. I'm a researcher at the University of Reykjavik. I'm actually in an interdisciplinary computer science group, but we've been working on trying to build an accurate simulation of the banking system so that we can explore its behavior, and in particular so we can understand things like index-linked loans and how they behave and interact with the macroeconomy. So index-linked loans, if you're not an Icelander, are interesting. If you're an Icelander, I imagine they're something of a nightmare. They are negatively amortized loans linked to the central bank's base rate, but also linked to the CPI. And so essentially, if inflation goes above 3%, then their principal increases, and that is negatively amortized. That is, it's added to the amount outstanding. Now, anywhere else in the world, if you were thinking of taking out a negatively amortized loan that behaved like this, the advice you would get from any responsible financial advisor would be don't. They're generally regarded as a very dangerous form of investment or borrowing. Here, of course, we haven't had any choice. These were the only form of lending that were available for quite a long time. And it's good to just look at the difference in how they behave. This is a standard compound interest rate loan that you would receive in North America, for example. And as you can see, you basically pay the same amount every month. And as you pay that, the principal that you owe goes steadily down. And at the end of the loan, you've paid everything back. This is an index-linked loan. As you can see, it behaves quite differently. In theory, at least, you pay a steadily accelerating amount of money every month as the indexation kicks in. The principal grows until about halfway through the loan, and then hopefully your payments manage to overcome that, although in practice I think a lot of people actually end up just refinancing. It is linked to the CPI, so if you do, as happened briefly after the 2007 crash, get a reduction in the indexation, in theory at least the principal can be reduced as well, although whether or not that happens depends on the exact loan conditions. They were introduced, as we all know, because of the hyperinflation. The hyperinflation goes back, in fact, to the 1960s, where it seems to originate. A lot of the time we're told that the index-linked loans stopped the hyperinflation. There's actually not a lot of evidence for that if you look at the figures. The hyperinflation itself was probably caused by a combination of the Bretton Woods Treaty collapsing and, unfortunately, the Icelandic government printing money. When governments do that in a reserve-regulated banking system, it kicks up a multiplier effect that rapidly expands the money supply, which you can see in this diagram here. If the claim was true that indexation stopped the hyperinflation, we would expect the hyperinflation to actually stop when indexation was brought in. In fact, it continues for some time. And we would also perhaps expect the second hyperinflation that occurred 2005-2007 to not occur. Probably what stopped the hyperinflation was a combination of the wage agreements, and it just eventually bled its way out of the system as the system adjusted. Monetary expansion is not quite the same as inflation. It's very close. There's a very good correlation when you look at it historically. But inflation doesn't catch the entire costs that are being increased by the monetary expansion, so there is some variation. This is quite fortunate because you can see in the second hyperinflation, although the money supply in fact doubled in under a year in 2007, the corresponding increase in the CPI wasn't quite as bad as it could have been, and this is probably because a lot of money essentially was trapped in certain parts of the monetary system. So on the face of it, index-linked loans are, from a consumer perspective, just a very expensive way to borrow. And if that was all that was the case, that probably wouldn't be so bad, but unfortunately they also interact with the monetary system itself. And to understand why that is, we have to look at the way they're actually handled within the banking system's bookkeeping. Now, when a loan is created, money is basically liability money, deposit accounts are basically increased, and so is the loan. This is the amounts you can see being credited here. When the banks go and increase the principal as a result of indexation, the consequence of all this is that they have to do something on the other side to match that increase. And what they do is they essentially recognize that increase due to indexation immediately as interest income. It's called non-cash income, but it's treated the same way. So essentially what the banks receive as a result of that increase in lending is an immediate increase in their income, and that reflects as an increase in the money supply as well, because the two things are directly linked. Now, that can only occur when inflation is above 3%. So there's kind of a little zone where the Icelandic banking system behaves more or less like everybody else's, and we're actually in that zone now because inflation is so low. But at any greater inflation than 3%, what actually happens is there's a positive feedback loop. And the principal of the loans grows because inflation grows. The banks essentially create more money because of that. That's recognized as income, enters the economy, adds to inflationary pressures, and the thing goes around itself. And you can see this under simulation as well. This is a simulation essentially of two banks. They are in all respects identical to each other. They have the same number of borrowers, the same starting conditions, the same amounts are being borrowed, and the same interest rates are being applied. The only difference is that Basel Bank 5 is making standard compound interest rate loans as you might get in America, and the indexed bank is making Icelandic index-linked loans. And over time, we can see some interesting differences. One is the Icelandic bank is a lot more profitable than the American bank. It's getting a lot more in interest income. The other, which is also quite interesting and a little bit subtle, it's not lending as much. This was a bit weird. It was quite interesting when we noticed it. The reason is banks lend partly as a result of money that's been repaid, and partly from new money that's being created all the time. Most banking systems essentially exist in a state of mild expansion, where they're always creating a little bit more money than is being repaid every year. And this essentially means that there's more new lending every year than there would be otherwise. Now, the Icelandic banks don't do that as much, because the new money that they're creating, rather than coming from new loans, is actually just increasing the size of the existing loans. It's not easy to estimate the size of this effect because it depends on other things. Banks are regulated on how much they can lend, and so if the regulatory limit kicks in, then essentially the bank won't be able to lend more even if it wanted to. This framework of regulation has changed quite a lot in the last 15 years, and that's probably part of the causes of the financial crisis in the 2000s. But banks essentially are now limited by their capital, and capital is increased from profits. So the more profitable a bank is, the more it can lend, and of course the indexation adds to the profitability as long as the inflation rate is above 3%. So rough estimate is that probably the Icelandic banks were not lending about 2.5% less than a similar bank would be abroad, or they're creating more money than they should be, which again feeds back into the inflation rate. So they're not the greatest things to have in your financial system would be, I think, the understatement of the century. The situation today, I think nearly 8 years after the crisis, there's still a lot of them being taken out. People are switching to compound interest rate loans very wisely. But the majority of new lending is still indexed, according to the central bank stability report. And the reason for that is probably because otherwise it's hard to afford property at all. Prices are very expensive and increasing. Rental prices obviously are going up. Inflation is going down. But the reason for that is something that is completely unrelated. It's the decrease in the oil price. Now, this is what economists would call a shock. It's somewhat predictable, but essentially because oil is causing, at the moment, worldwide deflation by decreasing the cost of a major input into most production. Prices are dropping around the world, and country after country is starting to enter deflation. In fact, France announced deflation this month, and I suspect we will see it here in Iceland as well. The inflation rate at the moment is only 0.8%, and the oil price drop is huge. It's dropped by about half. So what does that mean for indexation? Well, the logic of these loans is that if there's deflation, the capital should decrease. Whether or not that actually occurs, I think, would depend on the loan conditions, and I'm told that at least some of them, there's a ceiling below which they can't be dropped, which does seem a little unfair under all the circumstances. But absent that, not only are the banks essentially hurting because they don't have the excess profits due to indexation because the inflation rate is so low, but if inflation actually goes below zero, then in theory at least they have to start reducing the capital of these loans, and that comes out of their profits in the same way that when the capital was increased, it increased the loans. There are a couple of things that will intervene probably to stop that. One is the way they're calculated. They seem to be calculated quite deliberately to prevent deflation hitting the capital. The Janus rule essentially averages the applied indexation across a 12-month period, which acts to stop short contractions in the money supply from having any effect. The other problem is that when you get these kind of deflations that are due to essentially production, so not because the money supply is contracted, which can also cause deflation, but just because something has gotten a lot cheaper, there's more of it in supply. That's somewhat short-lived. And while it can reduce prices in the short term, it's a very different mechanism to monetary inflation, which is probably still going on in the background. You just don't see it because it's temporarily being masked. So while there may be a deflation in the short term, in the long term, the system will probably rebound back. It's hard to say, but I think the next 6 months to 12 months could be quite interesting. If you're curious about what all this is based on, the system we're calling Threadneedle is in beta trial at the moment, and we will be making it open source, so anyone who wants to can download it and try and play around with the banking system and see if you can crash it, which actually isn't that hard. It's developed here in Iceland. It was financed by Ranus, and is, as far as we're aware, the first time anybody in the world has tried to build an actual simulation of the banking system to see what it does, based on what the banking system does, its transactions, rather than a mathematical model derived from observation. And we've already found several interesting things, including the work on the index loans. So we're hoping that it will be a useful tool, both for education, in helping people understand how the banking system really does work, and also for research. Thank you very much.